right, welcome back, traders and investors, to Benzinga's pre-market prep show. We're here with Sean Emory, portfolio manager of GFG Capital and author of themarketmeter.com. Sean, welcome to the show. How you doing this morning?
I'm doing great. Thanks for having me.
Yeah. I hope you've been having a good week with all this Fed and everything that's been going on. Everybody, it seems to be buying the market the past few days. Hopefully, you're the beneficiary of such activity.
Of course. I mean, over the last, I'd say 2 weeks, we've had a pretty wild ride, 4% down, 4% up. Not something that you see or pretty typical of the markets the past couple of years, but we're definitely beneficiaries of these last couple of days. So,
Sean, talk about the marketmeter.com. What's that all about?
yeah, so I guess to preface a little bit about my investment approach, and that's primarily what drives the market meter. It's my valuation approach, but also taking other type of investment approaches, techniques to really form a market thesis. So every stock, every country, every investment has its own story. So having a kind of broad set of, I'd say, tools allows for myself and my clients or my readers to take advantage of those different opportunities that are out there. So the market meter was really formulated because I saw that there was a lack of, I guess, research and information that the everyday investor had access to. Everything from global valuations to global credit or risk metrics that was really lacking for your everyday investor. So what I do is pretty much use all my different methods of investing, whether it's my fundamental approach, my technical approach, and really express that to my readers. So you'll go on there, you'll get a fundamental approach on a stock or a country, you'll get a macro-based write-up on a certain country, or even you'll get a technical type of investment thesis on a market or a single investment. So it's a place where your everyday investor can get access to institutional type of research, type of information and way of thought, and really expressing that on a daily and weekly basis.
I'm looking at your risk indicators here. This is really interesting. You got this laid out really nice at this risk indicator box. Talk about that. Like you've got different colors here, red, moderate, and strong for risk indicators. What's this all about?
Yeah, so that's exactly what I was saying. I mean, it's hard. You can't really just go on the internet and get a credit default swap for the globe or different subsegments of the market. You can't really find places where you can get the 30-day VIX, the 90-day VIX, and put that all together and manipulate the numbers so that you can really analyze it. So on the risk metric sheet on the site, really I look at, I'd say, 12 to 16 different metrics, and I look at more on the back end, but those are the ones I want to highlight. And I look piece by piece, whether it's earnings season, whether it's short-term volatility, whether it is a kind of interrelationship or intermarket relationships, discretionaries versus staples, and really gauge the sentiment and what's driving this market, how healthy is this market. So every single week I look at those various risk metrics and articulate whether it's strong, kind of moderately, I guess, neutral to weak. And I guess today, a lot of things are strong. There are some shorter term technical things such as stocks versus bonds that have not made all-time highs or new highs. The discretionary to staples relationship has still failed to take out previous highs. Those are red flags in the market, but there's also a lot of strong things such as earnings season remains positive. If you look at the relationship of 30-day volatility to 90-day volatility, the difference between the two is at levels that are pretty bullish today. And we're actually updating them today. So once I get to my sheet, I'll update those this morning or later this afternoon, and we'll get a sense of where the market is. But it's a good way to analyze risk and actually have a clear process about it.
So all these risks here right now that you're looking at, and the stocks are, we were making new all-time highs here actually on the S&P futures. We touched a new all-time high here overnight. How does this look comparative to where we were 3 or 4 days ago? Because 3 or 4 days ago, everybody was throwing in the towel and saying, "Oh, we're in real trouble here, and this market's going a lot lower because crude." And now, Yellen comes out and everything changes here. Are you seeing changes in these indicator boxes here in the last 2 or 3 days?
So plenty of those are green and actually healthy. The ones that are pretty much neutral to red are the ones that are still neutral to red today. So we've failed to make the stocks versus bonds relationship. If you go back to 2008, you go back to 99, that relationship's pretty important. That's money flow. That's where the money's going. So we want to see stocks outperform bonds. That still has failed to make new all-time highs. And if you look at, again, discretionary versus staples, very much cyclical versus defensive, the money flow is still to the defensive staple segment. Yeah, there's a caveat. I guess you could look at staples offers you a little more yield, and that's kind of the environment we're in today. So you kind of have to look at that, step back, see what's really driving that relationship. But that relationship, too, was a pretty decent indicator previous to 2008 highs or peak, and then the 99 peak. So I guess the red ones there, the ones that are flashing red signals or red signals, are still present today. Nothing's changed. But you still see a lot of good fundamental things, especially earnings season. And that's what I really want to harp on, is the correlation on earnings season. And that's really my backdrop, and my true philosophy is take a 50-year chart, earnings, and the stock market, and you'll see a pretty strong correlation. That's what really drives returns. But if you're looking to hedge your portfolio when risk presents itself, this is what we're trying to do with these risk indicators.
So what are you looking at here trading today? We've got S&P futures that just touched new highs, but we're pulling off those highs here right now as we're speaking. Are you looking at this market here? We just rallied 100 S&P points here. Are you looking at this, as, we're going to be continuing on into the end of the year, have the Santa Claus rally and just continue higher? Or are you trading this market a little more cautious here?
Yeah, so I'd say a little more cautious. So about 3 weeks ago, I made a post, and it was really talking about it's time to short small cap. That was basically drawn because of the same things I was talking about before, those different relationships, intermarket relationships. But I still hold that thesis that right now is probably, while we're not at all-time highs for the Russell 2000, it's still a good time to hedge your portfolio with small caps. I guess to start the year, we totally removed small caps, dedicated small caps kind of exposure at the beginning of this year, and that was driven by valuation. It was trading at like 28 times earnings. It was trading at 3.5 times book. And at those levels, if you took those valuation metrics and look in historical perspective over the last 60 years, at those levels, the forward-looking returns were about 2% over a 5-year period annualized. And the risk-reward was really asymmetric and skewed to the downside. So we still think small caps is the place to do to hedge your portfolio. We do like a lot of segments of the market. I guess going into this next year, some of the things that we're looking at is cash is king. If you look at, I guess I tweeted out or on a couple other different portals, current assets as a percent or cash as a percent of total assets is at all-time highs. You compare that to other periods like 08 and 99, where markets peak, that relationship or that percentage of cash as a percent of total assets was actually bottoming out. So what you're seeing is a market that's making all-time highs, but companies have the resources to support their stocks, support their earnings, and that's one of the themes that we're playing, looking for some of these transactions that are going on within the market, whether it's Xerox today or Samsung, potentially increasing their dividend by 50%. I think they just announced that here in the last couple of days. That cash that is going to support some of these blue chip stocks and also support some of these other parts of the market. So that's one theme. I'd say Asia. We've been a big, believer in Asia this year, and at the beginning of the year, that relationship, we got out of small caps, moved into Asia. And why? Because we had valuation support at those levels. If you looked at China, for example, it was trading at 8-9 times earnings. Those were pretty much trough levels over the last 15 years. Country itself, whether you believe the numbers or not, it's growing at 7.5% a year. If you back that up over the last 10 years or so, at a GDP of 7.5%, the average multiple was around 11. And it's trading at 9 times earnings, half of the U.S., 30% discount to the rest of EM. That's a place that we think is giving you some potential upside, and we've seen it this year already, but also you have some support to the downside just based on valuation.
What do you think of the crude market here? What are you looking at on crude? Because we've been hugging here near the lows here for a few days now, 54. This has been an unprecedented sell-off here in crude over the last 6 months, going from 100 all the way down to this 54 area. Are you looking for this crude to eventually bottom out here in this 54 area, or do you think crude just continues lower?
Yeah, crude's tough, right? Because it's not something that is, I guess, extraordinarily transparent. So who's manipulating or moving these markets, and it's OPEC. And to understand what they're going to do is pretty difficult. So for something like crude, it's purely technically driven in our opinion. So I'm looking at the technicals, trying to see if I can find some signs of bottoming out. Today, I'm seeing certain stocks potentially bottoming out. So Halliburton is potentially putting a bottom. But again, that's going to be based on the price of crude. So here at the 60 level, you're looking at some support, it seems, over the last couple of days. Hopefully that holds. I don't want to make a decision if this is the low, but I'd say if you think this is the low, have tight stops, make sure that you're managing your risk accordingly. And if you want to play a potential rally in crude, have your tight stops and play it that direction. I don't think trying to play it around OPEC's decisions, because you're going to get a fast move around those decisions just depending on what they say. I have no feel on crude particularly because it's not that easy to figure out, I'd say. So I stay away from the actual commodity, look at some potential beneficiaries of that, and then also look at some of the stocks that have been beating down that are trading at nice valuations that you could potentially pick up on if it does bottom out.
Sean, it's Garrett here. I wanted to ask you, I'm listening to you guys going back and forth, and you have fantastic material. I was wondering if, as you're going through this, if you've seen anything going on with maybe investors or traders, like if you had an opportunity to maybe say something or give somebody advice about a way to look at markets or handle changes in markets, what would be your piece of advice for other people? What do you think, like, your edges over everyone else, and what kind of advice could you give to somebody that maybe is looking to, get used to the markets or get into the markets?
Yeah, I'd say first is develop your process. Understand who you are, what drives you, and understand what drives the market. But for the most part, have a process, put that in place, and follow it. I'd say another piece of advice that I think really helps is patience. So I'm a value investor for the most part, and I have little segments, like I said before, other techniques that I use, whether it's technical trading or some other pieces. But be patient. So markets go up, markets go down. A lot of people chase rallies and they'll sell their losers. So my real advice is just be patient, find a country, find a company, assess its valuation, understand if it's attractive at these levels, and that gives you kind of a safety net, having some valuation, but staying patient. If you like a company, just based on the company, like a GoPro, you think it's a really strong business that's growing at a fast pace, understand the valuation, and you won't get caught in these kind of traps like you've seen over the last 3 months in that type of stock. It's a commodity business, but be patient. There's going to be a price where it gets to where there's a decent valuation there. So Facebook a couple of years ago, the initial IPO, I mean, you were getting a stock at 110 times earnings, and they were barely breaking even. So if you just waited and allowed the company to actually develop itself and be patient through the process, you could have picked up Facebook at the 25 to 19 and then rode that stock up as it revalues and the business actually starts to develop. So I think being patient is one of my key rules, and that's what I do and that's what we do.
Awesome, and apparently it's what the Fed does too. Everybody's patient around here these days. So, Sean, thank you very much for coming on, my man. We're going to wrap this up here, and I appreciate you taking the time to talk to us. Folks, we had Sean Emory, portfolio manager at GFG Capital and author of themarketmeter.com. Sean, thank you.
Awesome. Thank you for having me.
All right,
Thanks,
have a great
Sean.
weekend, buddy.